Warren Buffett, also known as the Oracle of Omaha, is considered as one of the most successful investors of all time. He's the chairman and CEO of Berkshire Hathaway, and at 91 years old, he continues to lead the company to success. As of 2023, his net worth is estimated to be $107 billion. Despite his immense wealth, Buffett is known for his philanthropy and has given $41 billion in the last 15 years. He's a major contributor to the Bill and Melinda Gates Foundation, as he has been a longtime friend of Bill Gates. Despite his immense wealth, Buffett is known for his frugality. In fact, he still lives in his Nebraska home that is worth around $650,000 today. He could obviously afford a much more expensive home, but this is not his concern. He's known for his simple lifestyle, drinking Coca-Cola, eating Cheetos, and reading. He is a stock market investor and has made his fortune through investing in companies. In fact, 99% of his net worth was earned after his 50th birthday. Millions of stock market investors idolize Warren Buffett and his investment philosophy. He's known for his long-term investment approach and his ability to identify undervalued companies with strong fundamentals. He's also known for his contrarian investment strategy and his ability to go against the crowd. In this article, we will be exploring 7 ways that you can think and invest like billionaire Warren Buffett. Despite being friends with Bill Gates, Warren Buffett typically doesn't invest in tech outside of Apple. He has a strong belief in investing in what he knows and has been quoted saying, "I try to buy stock in businesses that are so wonderful that an idiot can run them, because sooner or later, one will." This approach has served him well over the years and has helped him to become one of the most successful investors of all time. We will see in this video the 7 principles that he has followed throughout his life and which have allowed him to become the best investor of all time. 1. Invest in what you know and understand. It's unlikely that you've ever heard about Warren Buffett investing in marijuana or cryptocurrency markets. This is because, unlike many other investors, he is known for investing in simple businesses that he understands. He doesn't invest in something if he doesn't understand it. This approach has been one of the keys to his success as an investor, and it's something that investors should keep in mind when trying to emulate his investment strategy. In order to invest like Buffett, it's important to understand the companies you're investing in. One way to test your understanding is to use the elevator pitch method. This involves being able to explain what the company does and why you're investing in it within 30 seconds. If you can't, it's unlikely you fully don't understand the investment. This can lead to poor decision-making in the future. For example, if you see your stock price go down and don't understand the reason, you'll be more likely to panic sell at the bottom, missing out on any potential rebound. On the other hand, if you could see the context around the stock price declining, you might be able to see the short-term drop in price was nothing to worry about. Another thing to consider is that while marijuana and cryptocurrency are hot topics in the investment world, they may not be suitable for everyone. These markets can be highly volatile and risky, and they might not align with your personal investment goals or risk tolerance. So, what companies does Warren Buffett invest in? Warren Buffett does have some favorites. He invests heavily in banking, insurance, consumer staples, and utilities. All of these businesses are easy to understand, they have a steady and predictable revenue stream, and they have a strong competitive advantage. The reason why he likes these industries is that they tend to be less affected by economic downturns and they tend to have a constant growth rate. Each of Berkshire Hathaway shares their largest positions in companies throughout their annual letter to shareholders. A common theme among the companies they invest is durability, as they tend to be long-established businesses with a track record of success in various market conditions. Additionally, you can see a clear focus on industries such as financial services, banking, telecommunications, food and beverage, airline, oil, and automotive. One of the most notable positions is Apple, which stands out as the only technology stock in their portfolio. Despite Buffett's known aversion to technology, he has invested in Apple due to his belief that they produce extraordinary products that have become an integral part of daily life. If you're looking to emulate Buffett's investment strategy, it's worth considering investing in some durable blue-chip stocks, such as those found on the Dow Jones. 2. Understand price versus value. Warren Buffett is a long-term value investor who focuses on the underlying value of a company's shares. Determining the intrinsic value of a stock can be challenging, which is why Buffett often advises individual investors to invest in low-fee index funds instead. These funds allow investors to track the overall market rather than attempting to outperform it through stock picking. Given that the majority of individuals who try to beat the market are not successful, index funds can be a more viable option for many. When it comes to investing in stocks, most people tend to focus on the current price of a given stock and aim to invest in market high flyers. However, few take the time to consider the actual value they are getting from the investment. Value investors do not invest based on hype. They invest based on fundamentals. They study the company's financial statements and they buy shares of companies that are trading at or below their intrinsic value. In contrast, most market high flyers and technology stocks are trading at valuations that are significantly higher than the company's real value. 3. Invest for the long haul. Warren Buffett's investment philosophy is centered on a long-term approach. He takes his time in identifying investment opportunities, and once he buys shares, he rarely sells them. Some of his investments date back decades, such as his purchase of American Express stock in 1964. To emulate his investment strategy, it's important to adopt a similar long-term mindset when it comes to investing. Buffett doesn't pay much attention to short-term performance. Instead, he focuses on what companies will have a competitive advantage over the next decade or more. It is important to remember that stocks are a long-term investment, and the movement of share prices in the short term is unpredictable. Attempting to predict the short-term movements of a stock is almost impossible. 4. Be greedy when others are fearful. Benjamin Graham, who is Warren Buffett's mentor, once said that the market is constantly swinging between optimism and pessimism. Buffett learned from Graham to adopt the approach of being greedy when others are fearful and fearful when others are greedy. When optimism is high, it leads to greed, and when pessimism is high, it leads to fear. This approach involves buying stocks when there is fear in the market, or buying low, and selling stocks when there is optimism or euphoria in the market, or selling high. It's natural for people to want to follow the crowd, but when everyone is talking about a hot stock, it's likely a good time to sell it. The underlying value of a stock does not change in the short term, only the price does. At some points, the price is high due to greed and feelings of euphoria, while at the other points, the price is low due to feelings of fear. Most people make money in the stock market through asset appreciation, buying shares at a low price and selling them at a higher price. To invest like Buffett, it's important not to buy shares of stocks at all-time highs. He does not invest in high flyers of the market because it goes against his principle of price versus value and being greedy when others are fearful. When a company stock goes on sale, it's typically the time when one should buy, but people tend to be afraid to do so. Times of market pessimism are the best opportunities for investing in stock market, as stocks tend to be undervalued during these times. However, it is important to form your own opinion on investments and not be swayed by the opinions of others, including Wall Street analysts. Warren Buffett himself puts little stock in the opinions of analysts and focuses on forming his own opinion based on research and analysis. If you want to invest like Warren Buffett, it's important to adopt a long-term mindset, focus on the underlying value of a company, and not be swayed by short-term market fluctuations or the opinions of others. 5. Buy Berkshire Hathaway stocks. One of the most straightforward ways to invest like Warren Buffett is to invest in his company, Berkshire Hathaway. As a holding company, Berkshire Hathaway is owned by Warren Buffett and has a long history of impressive returns. From 1965 to 2017, the stock has had a compounded annual gain of 20.9% per year, which is significantly higher than the 9.9% return from the S&P 500. A lot of people are curious about the share price of Berkshire Hathaway, and for good reason. The share price currently stands at over $320,000, which is quite high and out of reach for most retail investors. Typically, when a share price becomes too high, a company will split the shares to make them more accessible to a wider range of investors. However, Berkshire Hathaway has not chosen to split its shares and instead offers Class B shares under the symbol BRKB, which currently trades at around $215 per share. While Berkshire Hathaway has an impressive history of beating the S&P 500, it is worth considering whether or not this stock is a good investment for you. One of the main reasons why it may not be is that, as a large investment fund, it becomes increasingly difficult for the company to find new opportunities. With a market capitalization of over $500 billion and a cash pile of over $100 billion, it's challenging for the company to find new investments, especially in small and mid-cap companies. Another important factor to remember is that Warren Buffett is 90 years old. If you're looking to invest for the long term, you'll need to consider what will happen to the company once he steps down or passes on. As the Chinese proverb states, give a man a fish and you feed him for a day. Teach a man to fish and you feed him for a lifetime. In other words, it's much more valuable to know how to invest on your own instead of simply following the strategy of someone else. 6. Pay attention to the management team. Warren Buffett places a great deal of emphasis on understanding the management team of a company before investing in it. He believes that a good management team is a crucial characteristic of any company that he invests in. Buffett evaluates how the management team treats shareholders, employees, customers, and even the environment. He particularly values honesty in management and looks at a number of factors such as share buybacks, dividends, dividend growth, and the overall reputation of the company. If the management team is acting responsibly, dividends should be paid on a regular basis with a history of consistently raising them, and shareholders should be rewarded through a company-sponsored share buyback program. If you want to invest like Warren Buffett, it's important to get to know the management team of a company. This includes reading annual reports, earnings reports, watching interviews, and studying the career path of the management team. Buffett also considers if the management team has an outside hire and where they worked before joining the company. While this may not be the most exciting aspect of investing for some, it's the extra effort of researching and understanding the management team that gives investors an advantage. If you're not willing to take the time to research and dig deep into companies, your best bet may be to stick to Buffett's two-fund portfolio strategy. 7. Invest in the two-fund portfolios. If Warren Buffett had made a career of selecting stocks, how would he have invested his money? Lucky for us, Buffett has provided an answer to this question in a letter to shareholders, where he outlined a retirement plan that is easy to implement. This plan does not require extensive research or stock picking and instead only involves investing in two funds. The first fund is a low-fee S&P 500 index fund, and the second is a short-term government bond fund. Buffett recommends investing 90% of your money in the S&P 500 fund and the remaining 10% in the government bond fund. In terms of funds, he recommends Vanguard products for their low fees and exceptional financial products. For the low-fee S&P 500 index fund, the Vanguard 500 fund is an excellent choice. Vanguard also offers bond funds, and a suitable option would be the Vanguard Short-Term Treasury Fund. These funds can be purchased commission-free on M1 Finance. Instead of trying to outperform the market, Buffett believes that the average investor should own the entire market. It's important to note that this portfolio is quite broad and may not be suitable for every individual's needs. If you're looking for a long-term investment plan, it's recommended to speak with a financial advisor. Even an initial conversation with someone who does this for a living can be quite informative. In summary, if you want to invest like Warren Buffett, you can follow his two-fund portfolio strategy. If you prefer to pick stocks, you can follow his strategies, but it's important to remember that the most crucial thing is to start investing. Investing like Warren Buffett, final thoughts. Just like anything else in life, investing is a journey. Even the greatest investors of all time make mistakes. Recently, Warren Buffett sold off his entire airline position after the global pandemic caused by COVID-19, resulting in millions of dollars of losses on this investment. While an investment in the airline industry met many of Buffett's criteria, a global pandemic that shut down travel was something that could not be predicted. The important thing to note is that you will make mistakes just like Warren Buffett does, even today. The key is to learn from these mistakes and find ways to improve. If the idea of reading balance sheets and studying annual reports is not appealing to you, individual stock investing might not be the best fit for you. Instead, you may find more success with the index fund investing approach that Buffett recommends. If you plan on entering the world of individual stock investing, it's advisable to consider implementing some of the strategies that successful investors like Buffett use.